We have massive insider buying over the last 12 months of $30 million, and today we are focusing on Amgen, the dividend company, which is also down over 4% today. So is there some strong undervaluation in this company that you need for your portfolio? As we can already see, 2 buy ratings from Wall Street and Seeking Alpha analysts, and as always we are going to do our deep dive into this company. We're going to look at their top line revenue growth year on year, as well as their bottom line net income. We're going to take a look at the health of this company, their total cash versus their total debt. And we'll look at not just the insider buying that we have noted of $30 million, but we're also going to analyze the institutional buys versus the institutional sells. We'll also take a deeper dive into their financial metrics. We'll take a look at their dividend safety, which does look to be safe, looking at their free cash flow, their debt levels, as well as some others. And we'll take a very quick look at their earnings, which they did report just a few days ago. As always, we are going to run them through our own valuation model, so we get to our own intrinsic value, what we deem to be our acceptable buy price given our investor margin of safety, and we'll also focus on Wall Street to see what their price target is over the next 12 months. So let's focus firstly on the historical performance, and as we noted, we do have buy ratings from Seeking Alpha, Wall Street. It is in the mid to upper end of the 52-week range, although we do note over a 4% pullback today. We see a forward yield around 2.9%, but again, as the stock has dropped over 4%, we can in fact see it is now sitting on the updated look at around the 3% level. When we do look at it on a trailing 12-month basis, a PE of 44 does look to be quite high, but we will take a look at the forward basis to understand in comparison to competitors whether or not this is the norm. And we can see over the last year, nonetheless, they've had that pullback today. They have performed very strongly, up 30%, and over the last 10 years, if you have been a shareholder, you would be up just under 170%. Bear in mind, if you do reinvest those dividends, it would be slightly higher. And we can see all-time highs of not too long ago at around $330 at the beginning of this year, 2024. So let's take a deeper look at the numbers. Now, top line revenue growth, as always, we do want to see a minimum of 3 to 7% as a baseline. We can actually see over the last 10 years, it has gone from around $20 billion in 2014 to just over $28 billion in 2023. So it has in fact increased by just under 50%. And over the longer term, we do note it has been increasing the right direction that we want to see. And we'll shortly look at the percentage format just to understand whether or not it is hitting those minimum levels we seek. Very similar story, we want to see the same on the bottom line, and we do note it has increased $5.2 billion in 2014, $6.7 billion in December 2023, and although the top line was increasing year on year, we do note a little bit more inconsistency in the bottom line. Yes, it has increased from 2014 to 2023, but we do see it isn't as straight up line that we'd like to see moving forward. In terms of the health of the company, their total cash versus their total debt, $27 billion in 2014, a very large amount, as we do know their latest quarterly report is in fact more than half of that, around $9.7 billion, and we can see over the longer term their cash position has been reducing. Now, that doesn't necessarily mean it's a red flag indicator. We do always like to compare that to their total debt, both numerically and directionally. And what we can see, their total debt has in fact more than doubled from $31 billion in December 2014 to just over $64 billion in that latest report. And again, when we do look at the trend, we do note it has been fairly flat over the longer period, but from 2021 it has increased over the more recent period. So something we will focus on when looking at both dividend safety as well as that net debt to EBITDA metric. Very important in understanding the overall health of Amgen. Now, again, what we like to do very quickly, their earnings per share, how do they perform versus essentially the analyst targets? And we can in fact see over the last 4 quarters, they have beaten, which is a very positive sign. Full quarter 1, 2024, a beat by 7 cents. When we do take a look at the essential analysis moving forwards, the expectation is that it is going to be a very large increase year on year of around 24%. So nice to note they do have a positive track record on a historical performance basis, but as always, we can't rely on history for future performance. Firstly then, we'll start off with the valuation grade. They do get a D-, no surprises off the bat, as we do see the very high trailing 12-month PE. When we're looking on a trailing 12-month PE gap, as we saw, 44, Those in a very similar sector, we do see them trading very high above the S&P of around 21, 22, but they are in fact lower than that of Amgen, around 33.26. When we take a look again at other metrics, if you want to see a P on a non-GAAP basis, 16.71, slightly lower than the sector median of 19.07. But one thing that we will take a look at more importantly is just comparing their own PE over the last 5 years to understand whether or not it is in line with the average or in fact higher or lower. When we take a look at their growth grade, well, they get a C+. A few metrics we can discuss. Year-on-year revenue growth, 12.76%, looking positive, especially given the fact that the sector median sits below 7%. In terms of growth moving forwards, just under 9%, not too far off the sector median, around 9.03%. And we do have some other ones here to look at. The one thing I would draw your attention to, 4.66%. This is essentially the earnings per share expected growth over the next 3 to 5 years. Not the greatest, especially when the sector median does come in at around 10.94%. But again, nonetheless, a lot of this information we can incorporate into our own investment thesis and then use it to understand whether or not it is a high quality company we want to add and exactly at what discount rate and margin of safety. So profitability, A+, nice to see some strong ratings now. Gross profit margin, very high, which is expected in the biotech industry. In fact, sector median at 56, Amgen smashing even that at 70.41. When we take a look at their bottom line, very positive on a trailing 12-month basis, 12.74. In fact, we see the sector median, so the majority in this essential industry, the biotech, coming in at negative 5.7%. Another positive thing, cash from operations on a trailing 12-month basis, 8.1 billion, and we can see here the sector median negative 16.17 million. So if you do want a quick summary, you can see the grades here, valuation a D-, growth grade C+, whereas the profitability looking the best of this company at an A+. Let's continue then and have a look at how they've performed on a total return basis, so reinvesting those dividends against others in the biotech healthcare industry. We have REGN, we have Vertex Pharmaceuticals, and a few others that we have also reviewed not too long ago, in fact, on this channel. Over the last year then, we do in fact see they are the best performing, up 35% if you were to include those dividends reinvested. If we were to expand it over the last 5 years, we do in fact see very strong performance, 96%, but there are others, in fact quite a few in this industry who have performed a lot better. When we extend it over the last 10 years, in all fairness, 253.6% is a very positive return over the 10-year period, but as we can see, a few others performing a lot better. We have VRTX as well as Moderna up 552%. Now, historical performance, whether or not you want to include that when you're thinking about this company, just bear in mind one vital fact, that even if they perform very well or even very poorly over the last 10 years or the last 20 years or 30 years, it really is very minimal in terms of an indicator for future performance. As we mentioned then, over the last 12 months, 30 million of insider buying. During the same period, we see 6.47 million of insider selling. Now, as we go through the different quarters, so the more recent quarter, Q2, we note 663k of insider selling. Q1, we have minimal movement. Q4, some more selling. Q3, we do see that very big buy, 30 million versus insider selling of 2.51. When we do take a look, you can in fact see it does also include US Congress members, not something we pay particular attention to. But in terms of the more recent movement, we have the SVP, Nancy G, who did in fact sell on the 3rd of May, just over 2,000 shares, total transaction of $662,000. Whether or not you want to include any of this into your own investment thesis, your own analysis, the data is there, you can use it, but as we can see, over a year period, a lot more insider buying than insider selling. Something we also see when we look towards the institutions, 76.5% of institutional ownership. Yes, 8.4 billion of sales over the last 12 months. Over the same period though, we see 80.5 billion, so a significant amount more of buying than selling. When we look at the more recent quarter, however, we do note more selling than buying, 675 versus 462. Q4 though, Q3, Q2 and Q1, so every single quarter in 2023, we do see the opposite, a lot more buying than selling. Again, overall, more buying than selling, more recent period, more selling than buying. Now, before we do jump into the dividend safety and the metrics, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any others, all completely free, click on the pinned comment below. You can start reading straight away. We just want to draw your attention to this article here, mainly for the fact that a lot of comments in the episodes we get are what are the websites we use, what are the resources. Well, if you read it, it is all explained in here, and again, it is free to read, so do go ahead and sign up. An interesting article that we did read, in fact, just last week about Amgen moving forwards. There is a lot of talk from companies like Eli Lilly, Novo Nordisk as well in terms of the experimental weight loss pill. Now, what exactly Amgen are looking to do? Are they going to scrap the experimental weight loss pill and move forwards with this same idea, however, using it as an injection instead? They have released some pre-data, and they have essentially said that while they are in the mid-stage of the study, it is an injectable drug, and they are very pleased with this result so far and do expect this to be coming out sometime soon over the next year. So very positive for shareholders, something just to keep an eye out though. Again, just something we thought we would share today. Finally, before we look at the metrics, they did report their earnings last week. Now, as we do know, their revenue, 7.45 billion, up 22% from the same quarter last year, so that is positive. However, they did bring in a net loss of 113 million. When we do compare that, again, they brought in a profit of 2.84 billion Q1 2023. Now, in terms of forward guidance, what they have essentially said is revenue is forecasted to grow around 3.5% per year over the next 5 years, or 3 years in fact, whereas the industry itself, 18% moving forward. So something we can factor in, and as we do know from when they did release their earnings, the share did go on a very strong run, up 15%, although we do know when looking at the performance now, it is down around that 4% level. So let's jump into the dividend safety, look at the underlying metrics, and then the valuation. Dividend safety score off the bat, 74. It does look to be safe. Market cap, 167 billion, a mega cap company. And as we said, on the drop today, it is essentially around a 3% yield. So in terms of the actual dividend safety, it was reaffirmed a few months ago, so a dividend cut does look to be unlikely. And in terms of the last recession, well, they didn't pay a dividend, so no comparative data. They had negative 3% recession sales, significantly above the average of the S&P, coming in at around negative 12, and they significantly outperformed negative 19% during that period on the recession where the S&P came crumbling down negative 55. Dividend growth, lots to like here, 5.6% last December, so a lot better than the 4% we advocate on a minimum to keep up in line with inflation. 10% over the last 5 years, double digit over the last 10 years, so looking very positive as a good dividend growth company, and 12 years of consecutive increases. Now, for those that are new, dividend yield theory does state a company is undervalued when the current yield sits above the 5-year average. So on this model here, we see reasonable valuation isn't too far off the 5-year rolling, and the same can be said on a forward P. We do note it is sitting at 14.8. Earlier we looked, it was on the trailing 12 months of around 44, so a little more reasonable. And when we do compare it to the healthcare sector at 16.1, Amgen does sit lower. So overall, with these different models, we don't look at any of them in singularity and will conclude towards the end. Free cash flow payout, for those that are new, we draw your attention to this as the earnings is susceptible to manipulation by management through accounting. Below 50% for biotechs if you want to be industry specific. I like a blanket rule. Below 60% just gives me faith that management can offer those double-digit dividend increases. And when we do take a look, we can in fact see it has been increasing over the longer term. 62% in 2023, not the worst worry. As I said, for me, 60% is sort of my maximum. We do know in 2024 expected to come down to 35%, so understandable why they did in fact have that dividend increase on the lower end in 2023. Next year, we should expect to see a much higher increase. Invest in those companies that increase their free cash flows. With Amgen, we do know, in fact, it has been fairly inconsistent. It isn't moving in the right direction, and we do want to point out 2024, we are expected to see a very large increase. In terms of the sales growth, well, very mixed. We did want 3 to 7% as we did look at the revenue. 2021, 2022, fairly low years. Nice to note, both in 2023, a 7% increase on the trailing 12-month, 13%. So hopefully in 2024, when they do release their full numbers, we should see some very nice double-digit growth to their top line. Another format of what we just looked at earlier, they also do something we didn't discuss earlier, returning the excess cash to your pockets by doing those share buybacks over the longer term. They have bought back a fair amount. If they continue to do that, it does mean your ownership over the company does get larger, so always a positive sign on top of those dividend increases. Then when we move on to the ROIC, as always, a very strong measurement of management and their ability to effectively allocate their capital. I like 10% or more, again, industry specific for biotechs around the 25% level. Now we do know it did drop into 2023, so something just to keep an eye on given the fact that it was fairly strong from 2018 to 2022. When we look at the margins, we know on both cases, operating and free cash flow, a very similar story, a lot better than the minimums we see, 25% for biotechs, 20% in terms of the free cash flow, but a trend is very similar. We do see, in fact, operational inefficiency on the margins as they do decrease over the longer term, the same to go for the free cash flow. Now, they are above the minimums, but I would just say quarter on quarter and in the annual reports, something we will keep our eye on as we don't want this to go below those minimum levels. Finally, we get to the net debt to EBITDA, which is the earnings before interest, tax, depreciation, amortization. These are essentially the number of years it would take the company to pay off all of their debt net of cash on hand, and we want to see below 1.5. Remember, this does affect the balance sheet strength. It correlates to both that as well as the dividend safety, and we do know it has been above that over the more recent years. The good thing to note, 2024 is expected to come down to 2.8, but again, something we do need to keep our close eye on. So let's jump into the valuation model. As always, if you enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now we jump into the first model. We're using the multiple valuation model. Companies in a similar sector and size, we have their average P multiplied by the EPS of Amgen to get the intrinsic value. Now on this model, we do in fact see overvaluation signal, but just remember we don't look at any of these one models in isolation. We then move on to the second model, the dividend discount model. Some very nice growth to their dividend over the last few years. On average, just under 21%. Using our growth rate of 5.5, that is what we have estimated to be a lot more conservative. We get an intrinsic value here showing some strong undervaluation, $380 with the market value of $297. We then move on to the discounted cash flow model. As we can see here, our free cash flows year on year. In terms of the average growth rate, pretty much flat over the last 10 years. Forward looking, we've gone in line with analyst targets around that 10% level. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get TXV value, divide by shares outstanding, and we can see that undervaluation signal again. So the intrinsic value here is just the average of these three models. For today's episode of Amgen, it does arrive at $329. As always, you can grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio and those in your watch list by clicking on the pinned comment below. Margin of safety, it stays the same in every episode. We start off at 10%. We don't execute unless we believe it hits those three golden criteria: wide moat, strong financial metrics, and good forward-looking data. So at 10% MOS level, we pretty much see it is trading around there now. We've got an acceptable buy of $296.23. It is trading at $297. So for today's episode of Amgen, we see a 10% MOS level based on our estimates and judgments. In terms of Wall Street and their forecast, well, they see 14% upside over the next 12 months. They have a price target of $340. But as always, let us know your thoughts as this biotech company, which is a very strong performer over the last few years. It is giving a yield now of around 3%. Is it one you are looking to consider? We did see some massive insider buying over the last 12 months. Are you looking to at least add it onto your watch list? Or maybe, for whatever reason, this one isn't for you. You prefer the likes of AbbVie or others in the industry. Or maybe just this industry isn't a void. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button. Let us know your thoughts below. And as always, we'll see you all on the next one.